Let's have a look at the objectives of financial management. So in order to fulfill its strategic role, there are a number of specific objectives that the financial management functions seek to achieve. It's all about the acronym PLEGS. PLEGS stands for profitability, liquidity, efficiency, growth, and solvency. So let's have a look at each of them individually. Profitability is all about the return that the business can generate from its production and investment activities. So it's the difference between revenue earned and the costs or expenses incurred in earning that revenue. Now, it's an important financial objective for a number of reasons. The first is it's going to impact the willingness of owners to continue their investment in the business. If the owners are not generating a good level of return, they're going to seek to remove their funds from the business and invest somewhere else that they can earn a higher rate of return. Secondly, if a business is generating high levels of profits, their shares are going to be in greater demand and the share price is going to go up. And thirdly, a business that is generating higher levels of profits is seen to be a more attractive and less risky investment by both owners or future owners and creditors, people or businesses that are going to lend the business money. The second reason it's important is it's going to look at the effectiveness of production and business activities. So are we making the right products? Are we marketing them in the right way? Finally, a business that is generating sufficient profits is going to have good levels of cash inflows. If we have good levels of cash inflows, then we are able to pay our debts when they fall due, and we're going to be able to remain solvent over the longer term. The next objective is all about liquidity. So the clip art there is a tap because it's all about their business's ability to turn on that metaphorical tap and have cash flow so that they can use that cash to pay whatever bill that is falling due at that point in time. So liquidity is the ability of the business to pay their short-term debts when they fall due. It's about ensuring the business has sufficient cash or assets that can be quickly and easily converted to cash to pay debts on time. It's an important financial objective for a number of reasons. Firstly, it allows the business to maintain a good credit rating. If you are paying your debts on time, you're seen as a good credit risk, and so therefore people are going to be more willing to lend you money. But not only that, you're going to have more generous credit terms and potentially lower interest rates applicable. The second reason it's important is it helps to maintain profitability. If we're paying our debts on time, we're reducing the chance that we're going to have to pay late fees or have to pay more interest. Thirdly, having good liquidity allows us to maintain good relationships with our suppliers because we're paying them in full and on time. Solvency is our next financial objective, and it's all about risk. So solvency is the ability to meet all financial commitments over the longer term. So both our short and our long-term commitments. Really, when we're talking about solvency, it's all about managing our risk. It's about reducing our levels of financial risk and ensuring that we can pay debts. Primarily, it's about not taking on too much debt so that we can manage those obligations when they fall due. Then we move on to efficiency. So efficiency refers to the ability to use resources effectively to ensure maximum financial return. It's about being able to generate the maximum revenue from all of our financial resources. It's important for a range of reasons as well. Firstly, it ensures that our resources are not wasted. So we're not spending more than we should on particular expenses. Secondly, we're going to have better cash flow because we're going to be able to collect our debts in a more timely manner. And so we're getting maximum return from all of those sales that we've offered to customers. Our final objective that we need to have a look at is that of growth. Now, growth is exactly as its name suggests. It's all about increasing the size of the business and the assets that the business controls. It's an important financial objective because the larger the business and its asset base, the greater the potential profits that can be earned. So in summary, there's a range of different objectives that the business wants to be able to achieve in order to fulfill its strategic role. Profitability, we want to maximize the returns to the owners of the business. We want to have the biggest possible difference between the revenue earned and the expenses that we face in the business. Liquidity, we want to make sure that we've got sufficient cash or liquid assets that can pay debts when they fall due. Efficiency, we're getting maximum return from our financial resources. Growth, we want to increase the size of the business and its assets. And then finally, our solvency, we want to minimize financial risk and ensure that returns are all debt is able to be paid in the longer term.